Hello and welcome to another free tutorial video. This time around, we're going to be talking about a concept known as operating leverage and go through what it means, look at a few examples of how to calculate it, and also go through the interpretation. Now, the reason this came up is because we got a question in the other day, actually many questions on this topic, asking what is the formula for operating leverage when you're analyzing a company's financial statements? And then what does high operating leverage mean? And is it good or bad for a company to have high operating leverage? So in this lesson, I'm going to explain the concept first, then I'm going to show you a few calculations and a few different ways of looking at this, and then I'm going to explain the interpretation and when this metric is useful and then when it's not so useful. The first answer to this question is that there isn't just one formula for measuring operating leverage. There are at least 3, possibly 4 formulas. I've actually found more than that, but we'll stick to just 3 or 4 formulas for now. But they all relate to the concept of fixed versus variable costs. So when you're running a business and you have to pay for an office and you have to pay for administrative staff and other things like that, those are all fixed costs. You're going to incur them no matter how much you sell or how little you sell. But then the variable costs relate to the costs for selling each individual unit or product or service. So if you sell a product and it costs you $50 to order the materials and supplies you need for the product, that is a variable cost. And the concept of operating leverage relates to this and how much in fixed versus variable costs a company has. The main question that you're trying to answer with operating leverage is, as a company's sales grow, how much of that growth actually trickles down into operating income? If a company has high operating leverage, then as its sales grow, a lot of those increased sales will translate into operating income and into increased profits for the company. If a company has low operating leverage, then that's not going to be true to the same extent. So as its sales grow, its operating income will also grow, but it is going to grow by less than it would if it had high operating leverage instead. So that's the first answer to this question. Now, the second answer about whether high operating leverage is good or bad is also a bit more complicated. The real answer is that, as with any type of leverage, whether it's financial leverage or operating leverage, more leverage means higher risk, but also higher potential rewards. And just as when a company takes on debt, or when a private equity firm uses debt in a leverage buyout, they're increasing the risk, but also the potential rewards. The same is true with operating leverage. The more a company has, the riskier it is to some extent, but the potential rewards are higher because of this point above, that as its sales grow, its operating income is going to grow by more if it has higher operating leverage. So here's an example of this concept in practice. If you take a company like Microsoft, they have fairly high fixed costs because before they release the next version of Windows or Office or any other software product, they have to pay for the software, they have to pay for employees, for developers, they have to pay to market the software, to test it, everything like that. So before the release of a major software product, they are paying a lot of money upfront to do that. But then when it's done, it costs almost nothing to sell each additional copy. How much does it really cost to deliver Windows or Office to someone, especially these days, now that you often just download it online when you purchase it? The answer is almost nothing. And so this is a company with very high operating leverage because there are a lot of fixed costs up front before the release of our product, but then very little in the way of variable costs thereafter. So if you think about it, if they sell 10 million copies of Windows versus 50,000 copies of Windows, their expenses are going to be almost the same. And this is a situation that we label high operating leverage because of that. On the other hand, let's say that we have a consulting firm or a services firm where all the expenses correspond to specific clients. So as they bill more and as they win more clients, they also need to hire more employees to consult for them. And the way it usually works is that they charge the clients an hourly rate and then they pay the employees an hourly rate. So in this case, if they bill clients for 1,000 hours versus 100 hours, they're probably going to have almost 10 times the expenses for the 1,000-hour case. And this is what we mean by low operating leverage. As their sales grow, their operating income does grow, but their margins stay about the same. And for each unit of growth they have, the operating income is going to grow by a lower percentage than it would for a software company like Microsoft because Microsoft's variable costs are so low. So that is what the concept of operating leverage means and a few examples of how to think about it. Now, we're going to go into the formula for it, and I'm going to show you a few ways to calculate it. We're also going to go into Excel in this part, and I'm going to show you firsthand what this might look like for a software company versus a services or consulting company. As I said, there are multiple different formulas, but we'll go through a few of the most common ones here. So one formula is to take the company's fixed costs and then to divide by the fixed plus variable costs. And this seems like a reasonable idea because after all, operating leverage relates to those fixed and variable costs directly. The problem, though, is that companies don't really spell this out for the most part. You can look in their filings and other reports, but you will rarely, if ever, get a company that tells you exactly what its fixed and variable costs are. Now, you can make estimates and you can guess this yourself. So, for example, for a retail company, their cost of goods sold is mostly going to correspond to variable costs because it corresponds to ordering the inventory and selling it, whereas something like rent or paying for staff members are mostly going to be fixed costs. So you can make guesstimates for this, but you never know exactly what it is for each individual company. Now, another way to look at this is to look at the percent change in operating income and then divide it by the percent change in sales. So if operating income grows by 10% and sales are growing by 10%, then you have an operating leverage of 1x because each percent increase in sales trickles down directly into each percentage increase in operating income. On the other hand, if operating income goes up by 20%, but sales have gone up by 40%, now you have a situation where it's 0.5x operating leverage. Now, this method tends to work a little bit better for real public companies because they don't disclose information on fixed and variable costs. A third formula I found is that you can take net income and divide by fixed costs. This one I don't think is terribly helpful because it doesn't have anything on the change in sales or the change in operating income or anything like that. And then a fourth formula that I found is to take the contribution margin and then to divide by the operating margin. The contribution margin relates to the company's variable expenses and shows the margin on just those variable expenses. So you ignore fixed costs and you just take the expenses that are related to the company's variable costs, and then you compare that to the operating margin because the operating margin includes both the fixed and the variable expenses. So let's go into Excel now and take a look at a few examples. We're going to look at a simplified one first for the same example of a software company versus a services or consulting company. Then we'll look at another example for several retailers that I found and look at a different way of calculating operating leverage there. So for the software company, we have this company that sells 10 million units of their software for $100 a piece. Their cost per unit is $20, and they have $400 million of fixed expenses, presumably relating to paying developers and project managers and the marketing department and other people like that. So let's break it down and take a look at their revenue, their operating income, and the other key metrics here. So for revenue, we just multiply units sold by the average selling price. For the fixed costs, let's use a negative sign and then go up and grab the fixed costs from there. And then for the variable costs, let's multiply units sold by the cost per unit. And then for operating income, we can sum up everything there. So the operating margin is easy. We just take our operating income and divide by our revenue. And then for the contribution margin, what we want to do here is take the number of units sold and then multiply by the average selling price minus the cost per unit. And then we'll divide this by revenue. So in this case, it is going to come out to a very high number because our variable costs, the cost per unit, are quite low. So here, essentially, we're going to get 800 million and we'll divide it by the $1 billion of revenue, which of course gives us a contribution margin of 80%. And then we simply take this contribution margin and divide by the operating margin. And this is one way you could calculate operating leverage if you actually have all this information on the fixed costs and the variable costs. And in many cases you won't, but sometimes, surprisingly, it can be a little bit easier to do it like this than it is to use some of the other formulas that we looked at. Now let's look at another case. This is a services or consulting company. They've sold 1 million units. It probably means 1 million billable hours or something to that effect. So I could change this and say billable hours sold, for example. Now, they're charging clients $1,000 an hour. So this is some pretty high-end consulting, maybe legal work or something of that nature. And they're also paying their employees $590 per hour for their work. So this is almost certainly something very specialized like legal work. So for the revenue, we're going to take our billable hours sold and multiply it by the average selling price of $1,000. So we get to $1 billion of revenue, just like our software company, but we do it in a very different way because we're selling fewer units at a higher selling price. Now for the fixed costs, let's go over here. For this type of company, their fixed costs tend to be lower, and they're actually much lower here because they don't really have that much in the way of fixed costs. They don't have to pay anything upfront for developers or the marketing team or project managers because they don't have that. They're not developing the product upfront. They're charging clients as the clients come along and hiring people and paying them based on the clients and the cases they have. Now for the variable costs, we'll take the billable hours sold and multiply by the cost per unit right there, and then we'll sum up those. For the operating margin, once again, we'll take the 400 million, divide by the $1 billion of revenue. And then for the contribution margin, same idea. We'll take our billable hours sold, multiply by the average selling price minus the cost per unit, and then divide by the revenue. And so in this case, we get to a very different story because we get an operating leverage of 1x instead. So if you look at this type of analysis, you might go through it and conclude that the software company is clearly better because their operating leverage is 2x, whereas the services and consulting company has an operating leverage of only 1x. And not only that, they're selling fewer units and charging higher prices, so there's more risk because they have fewer customers. A lot of these hours probably represent a few big customers. So it seems like in every possible scenario, the software company is better off. Now to show you what this higher operating leverage actually means, let's double the unit sales for both these companies. So let's double their units sold to 20 million. And for the software company, their operating income goes up by 3x, and it goes up from 400 million to 1.2 billion. But then for the services company, if you double the billable hours to 2 million, the operating income goes up to 810 million. So it roughly doubles, but it doesn't triple as it did for the software company. And that is the real meaning of operating leverage here, that for one company, if you have a high operating leverage or a higher operating leverage, then as your sales increase, the operating income is going to increase more than it would for a company with a lower operating leverage. And that's what this concept really comes down to. So you look at this and you think, okay, well, clearly now that we've been through the math, the software company is better in every way. Just one problem though. What about the downside case? So let's say that we only sell 5 million units right here. And let's knock their billable hours down to 500,000. And so now you can see the issue. We have the same amount of revenue for both companies now, but since our consulting company has much lower fixed costs, our operating income is now actually higher than it is for the software company. Why? Because our fixed costs are much lower, and as our sales fall, it doesn't hurt us as much because most of our costs are variable. Most of our costs are tied to billing clients for a specific number of hours, and so even if our business falls off a cliff, we're not really in that bad of a condition because we can also reduce our expenses as the sales fall. So that's the flip side of it, and that's why operating leverage is really a double-edged sword. Yes, it'll help you in the upside case, but if sales fall or the industry declines, a company with high operating leverage is going to be much worse off. Now, in real life, I have to also note that this scenario is somewhat implausible because a software company is not going to have fixed costs that are 40 times as high as a services or consulting company. So in reality, what should really happen here is that the software company should have a margin that is higher. Its operating margin should be higher, but the services company should have an operating margin that is lower, significantly lower in most cases. So fixed costs of something like 300 million might be more appropriate here. And so now their operating margin is much lower. The interesting part is that when you do this, their operating leverage goes up to 3.7x, but that's not necessarily a good result or even a meaningful result anymore because now the company's operating margins are so different that it's hard to even compare this. Yes, for the services company, as their sales increase, now that the fixed costs are much higher, yes, they will earn a higher percentage increase in operating income as sales go up, but their margins are so much lower that in absolute dollar terms, it doesn't really matter that much. They're earning a higher percentage of operating income as the sales go up by a certain percent, but it's not as if they're actually getting a higher dollar amount in operating income because the margins are so low. So that's a little bit about the concept of operating leverage using this example. Now, another thing I wanted to show you really quickly is that with real companies, the problem you often run into is that they don't split out fixed versus variable expenses. I have some discount retailers in the US here: Dollar General, Family Dollar Stores, CST brands, Target, Costco. Target is a little bit questionable, but we'll keep it there anyway. Most of these companies have operating margins in the 2, 3 to 10% range. The median is probably around 5 or 6%. And I've gone in and calculated operating leverage a different way. And I've used this formula looking at the change in operating income, the percent change divided by the percent change in annual revenue. And you can see that for each of them, it starts off at just over 1x and then drops to a much lower number by the end. You can really see what the concept means by looking at these numbers, because as revenue increases by about 1.5 billion, our operating income goes up by close to 100 million. We have operating leverage of 0.5x there, meaning that as our revenue increased, it didn't translate one-to-one into an increase in operating income. It was actually more like a 50% translation. And then in the next year, it's even worse, because now we go up by about 1.4 or 1.5 billion again. And once again, our operating income here goes up by a much lower number of around 30 or 40 million, it looks like. And so we go down to operating leverage of 0.2x. Now, for the others, the numbers unfortunately don't make as much sense. For the Family Dollar Store example, for example, it goes into a very negative number here because operating income actually falls. And then for the others, the numbers aren't great. But I just wanted to show you this as an example of what it looks like and how you can visualize that translation from top line revenue into operating income, which is what operating leverage is all about. We can see that even for Costco here at the end, their operating leverage also falls pretty significantly by year 4. So the overall conclusion here is that these numbers don't really tell us very much because they're all over the place. The only real trend is that operating leverage seems to be falling for all the companies. Some companies are doing a little bit better at translating top line growth in sales into operating income growth, but overall, the efficiency in this industry is not great and it appears to be declining over time. So those are a few real examples of how you might look at this. So let's go back into PowerPoint and into the interpretation and look at whether high operating leverage is good or bad. On the positive side, as sales grow, the company's operating income will grow by a substantially higher amount if it has high operating leverage, and its operating margin will actually increase. But on the negative side, if its sales fall or the industry goes through a downturn, things will get bad very quickly if a company has high operating leverage and high fixed costs. It's sort of similar to the risk of using debt in a leveraged buyout. There's more upside, but there's also more risk. And there's also more downside if a lot of debt is being used, because if the company doesn't perform well and can't repay its debt, then you could easily end up losing money on the investment. So how do you actually use this metric in real life? It depends a little bit on your firm's investment strategy. On balance, most private equity firms and other investment firms will tend to prefer companies that have a higher operating leverage, simply because, just as with leverage buyouts, if you can use more debt, there's a potential for higher returns. And with companies, if the company is using more operating leverage, then there is a potential for outsized returns. With the services and consulting example, if you think about it, their operating income is somewhat predictable because you know your costs. And as it gets bigger and bigger, you can pretty much predict how much of that is going to fall into operating income. But with the software company, it's much harder to predict, and you don't know what sales are going to be like. And if the units sold go up by 5 times, your operating income is getting increased by a serious amount. Whereas with the services and consulting company, that's not true to the same extent. And so on balance, most investors will tend to prefer companies with high operating leverage as long as their fixed costs are not too high. So that is the key condition you need to look for. Yes, operating leverage can be good, but only if the company is in an industry like software, for example, or biotech or pharmaceuticals that doesn't have much in the way of fixed costs to begin with. the ceiling really does tend to be lower when variable costs are much higher. So most investors will tend to favor companies with higher operating leverage, and it can be used as a screening criteria sometimes. So let's do a recap and summary now. Operating leverage is all about how much does revenue growth translate into operating income. As a company grows, how efficiently does it translate that growth into actual operating income for the company and ultimately into profit? The formulas all relate to fixed versus variable costs. You can look at the contribution margin over the operating margin, or fixed versus variable costs themselves, or you could look at the percent change in operating income relative to the percent change in sales. We would say this is slightly less ideal than the others because it's indirect and it doesn't relate really directly to fixed versus variable costs, but it is a way to do it if you're in a pinch and you don't have the numbers, or you're dealing with a public company where it's hard to figure out. The ultimate meaning of operating leverage is that it introduces higher risk in a lot of cases, but also the potential for higher rewards. So that's it for this lesson on operating leverage. I hope you got something out of it and understand this concept in a bit more detail now.